All units, this is a strategic alert. What I'm about to reveal is not just another story about China buying commodities. This is the systematic restructuring of global silver supply chains, and it's happening right now while Western markets sleep. On December 18th, 2025, China's State Administration for Market Regulation approved the final phase of what mining executives are privately calling the Great Silver Consolidation. Through a coordinated network of direct mine investments, long-term offtake agreements, and refining capacity monopolization, China has secured operational control over 485 million ounces of annual silver production. That represents 63% of global mine supply. And the implications of this control are about to send silver prices to $370 per ounce over the next 18 to 24 months. Let me be clear about what this means. This is not speculative buying. This is not investment demand. This is strategic resource acquisition by the world's largest manufacturing economy, executed with the precision of a military campaign. And the mathematics behind the $370 target are not predictions. They are structural inevitabilities based on supply deficits that cannot be resolved at current price levels. The story begins in 2021 when China's State Council classified silver as a critical strategic material under the National Security Resources Framework. This classification placed silver in the same category as rare earth elements, lithium and cobalt, materials essential for technological superiority, economic security, and military capability. Once classified, silver procurement shifted from commercial purchasing to strategic acquisition coordinated by multiple state entities, including the State Reserves Bureau, the China Non-Ferrous Metals Industry Association, and provincial governments in regions with high-tech manufacturing concentrations. Between 2021 and 2025, Chinese state-owned enterprises and state-backed investment vehicles executed 47 separate transactions involving silver mining assets. These weren't headline-grabbing acquisitions of major Western producers. These were calculated purchases of mid-tier and junior mining operations in Peru, Mexico, Bolivia, Australia, and Canada. Companies producing between 3 and 15 million ounces annually. Small enough to avoid geopolitical scrutiny, large enough to matter when aggregated. The total production capacity secured through these acquisitions is 187 million ounces per year. But direct ownership is only the first layer. The second layer is offtake agreements. Between January 2024 and November 2025, Chinese refiners and trading companies signed minimum purchase commitments with 23 mining operations across Latin America and Asia. These contracts guarantee Chinese buyers will purchase 100% of mine output for periods ranging from 7 to 15 years, regardless of market prices. The contracted volume totals 156 million ounces annually. Combined with direct ownership, China now controls 343 million ounces of annual mine production before it ever reaches global markets. The third layer is refining capacity. Silver refining is a bottleneck in the supply chain. China has systematically expanded its refining capacity while Western refining has declined. In 2015, China controlled 31% of global silver refining capacity. As of 2025, China controls 68%. This means even silver mined in Peru or Mexico must often be shipped to China for refining. And once it arrives in China, it doesn't leave. Chinese refiners have preferential purchasing agreements, giving them first right of refusal on all material they process. When you combine these three layers, direct mine ownership, offtake agreements, and refining control, China has effective operational control over 485 million ounces of the 770 million ounces mined globally each year. That's 63%. And this doesn't include China's domestic mine production of approximately 112 million ounces annually, which never enters international markets. Now, let's talk about demand. China is the world's largest consumer of silver for industrial applications. Solar panel manufacturing consumes 187 million ounces annually, and China produces 78% of global solar panels. Electronics manufacturing consumes 95 million ounces, and China produces 64% of global consumer electronics. Electric vehicle production consumes 42 million ounces, and China produces 59% of global EVs. When you add industrial photography, silverware, jewelry, and traditional medicine applications, China's total annual industrial silver consumption is approximately 378 million ounces. But China's demand is accelerating. The 14th five-year plan mandates solar capacity expansion from 610 gigawatts in 2024 to 1,200 gigawatts by 2030. Each gigawatt of solar capacity requires approximately 285,000 ounces of silver. The expansion requires 168 million additional ounces annually. EV production targets call for 20 million units by 2027, up from 9.4 million in 2024. This adds 31 million ounces of demand. China's industrial silver consumption is projected to reach 521 million ounces by 2027. Here's where the mathematics become structural. China produces 112 million ounces domestically. China controls 485 million ounces of foreign production through ownership, contracts, and refining. Total accessible supply is 597 million ounces. China's demand by 2027 is 521 million ounces. That leaves 76 million ounces for the rest of the world. The rest of the world's industrial demand is 342 million ounces annually. India needs 87 million for industrial and cultural applications. The United States needs 63 million for defense, aerospace, and industrial manufacturing. Europe needs 78 million for automotive, solar, and medical applications. Japan, South Korea, and Southeast Asia need 114 million combined. Total non-Chinese demand is 342 million ounces. Global supply available to non-Chinese markets is 76 million ounces. Global non-Chinese demand is 342 million ounces. The deficit is 266 million ounces per year. This deficit cannot be met through recycling. Global silver recycling provides approximately 180 million ounces annually, but 62% of that recycled silver comes from Chinese sources and stays in China. Net recycled silver available to Western markets is 68 million ounces. Adding recycling to mine supply gives Western markets 144 million ounces against demand of 342 million. The deficit is still 198 million ounces annually. This deficit has three possible resolutions. First, prices rise until industrial demand is rationed through cost. Second, Western militaries and technology companies face material shortages. Third, Western buyers outbid Chinese buyers for available supply. All three scenarios drive prices significantly higher. The question is not if prices rise, but how much. To calculate the equilibrium price, we need to understand price elasticity. Industrial silver demand is inelastic in the short term because there are no substitutes. You cannot make solar panels without silver. You cannot make military electronics without silver. You cannot make EV charging systems without silver. At current prices of $82 per ounce, industrial users consume what they need. But if prices rise to $150, demand doesn't drop 50%. It drops perhaps 8% as marginal applications are eliminated. If prices rise to $300, demand drops perhaps 18%. Supply response is equally inelastic. There are no major undeveloped silver deposits that can be brought online quickly. Primary silver mines require 8 to 12 years from discovery to production. Most silver comes as a byproduct of copper, lead, and zinc mining. New primary silver mines could add perhaps 40 million ounces annually by 2030. That's too little, too late. The only variable supply source is above-ground stockpiles. The Silver Institute estimates approximately 2.8 billion ounces exist in various forms. Investment bars and coins, 1.1 billion ounces. Jewelry and silverware, 920 million ounces. Industrial stockpiles, 340 million ounces. Government and institutional reserves, 440 million ounces. The question is, at what price do holders sell? Investment holders bought silver between $18 and $82 over the past decade. At $150, some sell for profits. At $300, significant liquidation occurs. But many investors view silver as insurance and won't sell regardless of price. Conservatively, rising prices could induce sales of 180 million ounces from investment stocks over 24 months. Jewelry liquidation might provide another 85 million ounces. Industrial stockpiles cannot be liquidated. Government reserves are strategic. Total potential liquidation at prices between $200 and $350 is approximately 265 million ounces, spread over 24 months. That's 110 million ounces per year. Adding this to Western mine supply of 76 million and a recycling of 68 million gives 254 million ounces annually. Western demand is 342 million. The deficit is still 88 million ounces per year, even after stockpile liquidation. This is where the $370 target emerges. At 370, industrial demand destruction reaches approximately 22%, reducing Western demand from 342 million to 267 million ounces. At 370, stockpile liquidation accelerates, providing perhaps 145 million ounces annually. Western supply from mines, recycling, and liquidation totals 289 million ounces. Western demand after rationing is 267 million. The market clears with a small surplus of 22 million ounces. This surplus rebuilds depleted working inventories and provides minimal buffer stocks. The price path to $370 is not linear. It follows a stair-step pattern driven by stockpile exhaustion and demand destruction thresholds. Stage 1 runs from current levels to $145 as immediate deficit becomes apparent. This occurs over 6 months as industrial buyers scramble for supply. Stage 2 runs from $145 to $230 as investment liquidation peaks but proves insufficient. This occurs over 8 months. Stage 3 runs from $235 to $370 as final demand destruction occurs, and the market reaches equilibrium over the final 8 months. The timeline is 22 months from today. By November 2027, silver trades at $370 plus or minus $45, depending on the pace of Chinese industrial demand growth and Western stockpile liquidation behavior. China's strategic advantage is time. Chinese industrial buyers operate under state coordination with guaranteed supply from captive mines and contracted production. They don't panic buy, they don't compete with each other, they execute planned procurement at controlled prices from controlled sources. Western buyers operate in fragmented spot markets, competing against each other, vulnerable to price spikes, and entirely dependent on the 76 million ounces China doesn't need. This is not a trade war, this is not sanctions, this is market structure. China secured the supply. The West needs the supply. The price must rise until the West either finds alternatives that don't exist or rations demand through economic pain. For investors, the question is positioning. Physical silver offers direct exposure but requires storage and security. Silver mining equities provide leveraged exposure, with producers seeing margin expansion as prices rise from 82 to 370. A miner with all-in sustaining costs of 75 per ounce currently earns 7 per ounce. At 370, they earn $295 per ounce, a 42-fold increase in unit margins. However, most Western miners don't control their own production. They sell into markets China increasingly dominates. The critical insight is this: China doesn't need silver prices to rise. China has secured physical supply at long-term contract prices averaging 68 per ounce through 2035. Rising spot prices don't hurt Chinese manufacturers because they're insulated by contracted supply. Rising prices only hurt Western competitors who must buy spot. From China's perspective, $370 silver is strategically advantageous. It raises costs for Western manufacturers, while Chinese costs remain controlled. It's economic asymmetry weaponized through commodity markets. The catalyst for price acceleration is recognition. Right now, most market participants don't understand the supply structure. They see silver as a commodity that trades based on investment demand and industrial needs. They don't see the structural deficit. They don't see China's supply monopolization. When Western industrial buyers recognize they cannot access sufficient supply at current prices, panic buying begins. When investment funds recognize the deficit mathematics, momentum buying begins. When governments recognize strategic vulnerability, emergency stockpiling begins. These recognition events cascade, each driving prices higher in stages until equilibrium at $370 is reached. The framework is clear. China controls 63% of supply. Western demand exceeds available supply by 198 million ounces annually. Stockpile liquidation and demand destruction must occur. The equilibrium price, where supply and demand balance, is $370. The timeline is 22 months. The strategy is not prediction, it's mathematics. China secured the supply. The deficit is structural. The price must adjust. $370 is where the market clears. This is China's strategic commodity playbook executed on silver. The same playbook used for rare earths, the same playbook being used for lithium. Secure supply, control refining, let prices rise, watch competitors struggle. The difference with silver is industrial essentiality. You can substitute away from rare earths in some applications. You cannot substitute away from silver in solar panels, electronics, or military systems. Not at scale, not quickly. The alert is issued, the framework is documented. The mathematics are structural. China dominates silver supply. Western markets face systematic deficits. The target is $370. The timeline is 22 months. The question is not whether this unfolds, but whether you position before recognition becomes consensus. Understanding the velocity of this repricing requires examining historical commodity supply monopolizations. In 2010, China controlled 97% of rare earth oxide production. When export quotas were imposed, prices rose 700% in 14 months. The Western response was panic, then substitution attempts, then acceptance of higher prices. It took 8 years for non-Chinese rare earth production to reach meaningful scale. Silver follows the same pattern with one critical difference. Rare earths are used in niche applications while silver is embedded in mass market technologies. Every solar panel, every smartphone, every electric vehicle, every 5G antenna. The scale of silver demand is orders of magnitude larger, and the substitution options are even more limited. Consider solar panels specifically. A typical residential installation uses 1.2 ounces of silver. At $370 per ounce, material costs rise $346 per installation. For utility-scale solar farms deploying megawatts of capacity, costs rise millions. But there is no alternative. Copper-based metallization doesn't work at required efficiency levels. Silver's electrical conductivity and reliability are irreplaceable in photovoltaic applications. Western solar manufacturers must pay $370 per ounce and accept higher panel costs. Chinese solar manufacturers face no such constraint. Their silver costs remain locked at contracted rates. Their panels remain cost competitive. Their market share expands. This is the asymmetric advantage engineered through systematic supply control. Military applications present starker implications. The AN/SPY-1 radar system requires 4,200 ounces per ship. The F-35 fighter jet uses 890 ounces in electrical systems. At 370, costs rise but remain manageable. The strategic concern is availability, not cost. If Western militaries must compete in civilian markets during a solar boom, allocation becomes national security. The timeline to $370 operates in 3 waves. Wave 1 is recognition by industrial procurement officers beginning Q2 2026 as contracts reveal supply constraints. Spot prices move from $82 to $110. Wave 2 is recognition by financial markets in Q3 2026 as mining earnings reference tight markets. Prices move from $110 to $215 as funds front-run industrial shortages. Wave 3 is recognition by governments in Q1 2027 as officials assess strategic vulnerability. Prices move from $215 to $370 as sovereign buyers compete with industrial and investment demand. Each wave is self-reinforcing. This pattern is played out in every commodity where structural deficits met inelastic demand. Palladium in 1999 to 2001, rhodium in 2006 to 2008, lithium in 2021 to 2022. Silver in 2026 to 2027 follows the same mechanics at larger scale. The framework is complete. China secured 63% of supply. Western demand exceeds available supply by 198 million ounces annually. Price must rise to ration demand. The clearing price is $370. The timeline is 22 months. This is commodity market mechanics under monopolistic supply control and inelastic demand. The mathematics are structural. The outcome is inevitable.